All right, and welcome to Trading Daily Options. I am Mark Sebastian, everybody's favorite trader. I was a floor trader for about a decade, and since then I started Option Pit and Carmeline Capital. Carmeline Capital is a hedge fund. Option Pit, which is what you're here for, is a full-service mentoring and consulting firm. On the consulting side, we will work with funds, money managers, asset managers, helping them implement option strategies, test option strategies, and optimize option strategies. So we implement, stress test, and optimize. On the retail side, on the education side, we work with retail traders, trying to teach them how to trade like a professional, the way we were taught. I had the luck of getting to spend a year being paid to learn how to trade options. You guys don't have that, but I can teach you the same way I was taught, and I can teach you how a professional thinks about trading, and that's what I really think differentiates us. We like to say that we're all the return with less of the risk. All right, because our approach is always risk adjusted. So today we're going to talk about what are daily options. We're going to talk about time value, where the pricing model doesn't work, some of the advantages of daily options and the disadvantages of dailies, some basic use of dailies, and then I'm going to talk about a little bit about overwriting and like a little call overwriting strategy and a cash secured strategy that I'm playing with. So daily options. There are two types of daily options. All right. One that you probably have heard of. Those are the ones that list one day, then expire the next. So if they list on a Thursday, they expire on a Friday. And those are typically binary options. Binary options are really interesting. I'm not going to be discussing binaries too much today, although they are interesting, to say the least. What this is really about is I'm teaching you about a product that's up and coming. So 5 years ago, nobody knew what the VIX was, and we at Option Pit were trading it. And here we are 5 years later, and now daily options are being introduced by the SIBO in SPX and SPY right now, but they are coming to many, many other products. So daily options in regular option contracts are options that are listed at varying time, but the net result is you end up with an option expiring every day. So these options list at all different times, but the week of expiration, there's an option expiring on Monday, Tuesday, Wednesday, Thursday, and Friday. We're not quite there yet, but I can tell you I know several people that work at CBOE, and they flat out told me we are going to list SPX options that expire every day of the week. SPY will follow. The Merck is listing daily options on their ES. That will then get into all the other options. 2 years from now, there will be daily options in the top 100 equities. There'll be daily options in the really active commodity contracts. Probably not VIX, although they might add like a Friday expiration VIX someday. That's about it. So, does anybody have any, has anybody here traded these dailies? How many of you know that there are options that expire almost every day in the S&P 500 now? I'm glad you guys are enjoying the crickets. Yeah, they've got Monday now. Yeah, there was ones that expired today. They have ones on Monday. And then in the weeks that there are quarterly options or end of month options, there can be 4 in a week in the SPX. So right now, there can be as many as 4 expirations in the SPX, and there can be as many as 3 expirations in SPY. This is XPX. All right, now right now, because of it just so happens that the quarterly option also happens to be a Friday. So because the quarterly option is a Friday, guess what? There's only 3 options that week, but there can be 4. My understanding is they're going to introduce a Thursday option likely sometime early next year, and a Tuesday option by the end of the year. If you look at the rollout, they're typically coming out about 3 to 6 months. There's volume. This is the part that's I think is fascinating, is there is volume in these. I mean, so look at SPX. In these daily options, this is just at the money. So this is a Wednesday settle, and look how much volume there was on these days in the SPX. This is Wednesday. Here's Friday. I mean, Wednesday settle out exceeded this is a standard expiration on, this is a standard quarterly expiration on the 16th. So, and different type of quarterly. It's not the annual quarterly. There's a listing for when a SPX option aligns with the expiration of a future. Those are also called quarterlies. So there was huge volume in the Wednesday. And then if you look, here's next Monday, plenty of volume there. Plenty of volume in the following Wednesday. I mean, all the way out. And you can see they list these really far out. I mean, these are a month away, and we have the, out to Friday. So you can see in October, we will have 4 options expiring in 1 week. Oh, no, we won't. Sorry. We will in November. No? Darn it. Not even in December. January, we will have, in January, even if they don't list the Tuesday, we'll have 4 options. We'll have the Monday SPX option that expires. You'll have the Tuesday end of month option expiring. You'll have the Wednesday option expiring, and you'll have the regular weekly Friday, the 3rd, expiring. And actually the Wednesday option, because this is a close, will be on that Thursday. So there will be some, oh, no, because this is February. Yeah. So these will have an option Monday, Tuesday, Wednesday, and Friday. How many have thought about approaches to trading that way? How does the fact that there is stuff to trade almost every day affect what you do? How should it affect what you do? Do you think that in a year, as these pick up volume, we'll be trading SPX calendars, butterflies, covered calls, cash secured puts in entirely different ways? Clearly, the answer is yes. All right. So now, before trading it daily, you need to understand the concept of decay. Decay is often presented as simple, but that's rarely the case. Decay of options is nuanced, and the key to forming trades with daily options. Understand decay? If you can get a real hard concept on decay, then you can trade the weeklies and the dailies. So remember, options is just another form of insurance. As time passes, insurance policies lose value. Even Evan, I have a friend named Evan, but that's not. Even on the last week, insurance policies still have a lot of theoretical value. Even the last day, insurance policies still have a lot of value. But much like insurance policies, options decay with that past time up to the last minute. An at-the-money option will have insurance value. All right. So just briefly, let's take a look at SPX. So this is last night on Tuesday. All right. Tuesday the 13th. And what I want you to be fascinated is S&P closed 2127. Look how much value is in all of these options. I could sell on the close yesterday a put 45 days out of the money, or 45 bucks out of the money. So a full 2% move at 55 cents. I could get over $1 for the 2100. So options decay exponentially as we approach expiration. The at-the-money vol ramps higher and higher and higher and higher. All right? That decay goes up and up and up and up and up exponentially. And up to that tiny last minute, it just goes boop, right at the close. But there's a lot of value in that. So that exponential decay is one of the real values of dailies. I mean, if you looked at last night, the at-the-money straddle was worth $17. Now, volatility was 18, so it was elevated, but there was a ton of value in them. So in theory, one should be able to harness lots of premium selling daily options on a regular basis, especially if you're using at-the-money. You know, if you want to buy stock and if you want to buy right at the monies every day, you can do really well. So the question is buy right. That means buy the stock and write an option. That is what a buy right means. So if I bought a future in the SPX or two futures in the SPX and sold an at-the-money call. So let's look at how that performed. Last night we settled 21.27. And we had that option, the 21.30 call, was worth $8.70. So the 21.30 call went out worthless. Let's say we paid the nickel. So we made $8.65. If we bought the future for 21.27, we lost $1.25. So net, we made $7.40 being long. All right, a similar trade would be this. This is a 2-day buy right. I'm buying the 21.25 70 3/4 future. And I'm selling a 21.30 call. And if I look at this on a 3-day risk chart, that is what the risk looks like. But is Decay that easy? Is it really that simple? Just sell an option and make money. So some things to remember, that previous chart only applies to at-the-money options. So the further out from at the money, the more that decay is not exponential but linear. So there can be periods of time in dailies where you can make more selling Friday instead of Wednesday. Or you can make more selling a month from now than 3 days from now. All right. So even in the last week or the last day, all right. No, wrong slide. That's slipped. So as time passes, out of the money options decay more linearly. So they don't get that huge exponential push. At the money options do get that exponential push. So believe it or not, there can be times where selling out of the money makes more sense to do in a month than in 2 days. You can make more. And here's just a, so while both at the money and out of the money options can decay to a point where they start to act like a coin flip, where they stop really having value other than just fear value. So a sale of a nickel option may have edge to it, but because of the risk associated, these little bitty options take forever to decay. So this is really what decay looks like on an out of the money option. So how is it all related? All right. So let's circle back to what we just learned about the edge and daily options. All right. The last week of an option's life has huge amount of decay at the money. The last day has the most. Out of the money options decay more linear, making this week and this day and last week look very similar. And nickel options take forever. So this is just an example I want to show you from General Motors from a while back. So General Motors was trading just under $36 at the time. So with it trading just under $36, if I sold with 2 days to expire, the April 10 calls I collected, or the April 36 calls, I collected 28 cents for 2 days. Now the May 1s have 22 days to expire, and I could collect 90 cents. So would I rather collect 28 cents over 2 days or 90 cents over 22 days? What's the better sale? What's the better sale? The shorter term. Clearly the shorter term. All right, but now let's look at some of these out-of-the-money options. So obviously GM is a lower volatility stock. Here we are a few days later. The GM 37 calls that have 9 days to expire, so they're $1 out of the money. They collect 14 cents in 9 days. The Mays that have 22 days again, 37 calls, are worth 51 over 22 days. So what would I rather do? Collect 14 cents over 9 days or 51 cents over 22 days? What's the better trade? Right. So depending on where you're selling, the daily option may actually not be your best sale. Does that make sense? The nice thing is when like I can make a joke about crickets and I'll actually hear crickets in the background. What do you think about that, guys? So when nobody answers and I say crickets, the crickets will answer. So well, better this than would you rather crickets a little bit in the background or a screaming newborn? A very cute screaming newborn. All right. So, and now let's talk about these really out-of-the-money options. All right. Take a look at these. This is on April. These have 2 days to expire. And the option that's $1 out of the money in General Motors, the low vol stock, they still have, those puts and calls still have value. Up to the last minute. All right. And if I showed you today, take a look. Now, take a look at SPY. All right, so let's take a look at SPY, and let me show you the option montage here. So it had an option expire today, and take a look. It closed 21.13, and the 21.12s, up to the last second, were nickel bid. The 21.13s, oh, it moved around after the close. That's why this looks screwy. But like the 21.13s had a bid. It looks like the actual close was 21.12.60 or 65. So you can see all these little options that are out of the money retain value through expiration. All right. So there's some things to think about. Dailies are for near the money options. If you want to trade daily options, you should be trading within one strike of at the money. If you are selling out of the money options, you may be giving away money and should be trading in the weeklies or in the back months. There may be a better trade. And those out-of-the-money options, all right, unless you want to take extra assignment risk, how many people here want to take assignment risk? Who wants to do that? Nope. So unless you want to take assignment risk, cover those things when they get to be cheap. Buy them back for a penny. Buy them back for 2 cents. If you sold an at-the-money option for some premium and you can buy it back for less than 10 cents, cover. There are better things to do with your time. You don't want to be married to your screen. These are options that expire within 1 or 2 days. If you can sell an option at 50 cents and buy it back for 15 in a few hours, do it. Don't get greedy. Right? We all get that? Good. Now, again, with both out of the money and these little teenies, there may be more professional strategies that make sense. Just people saying not me. They don't want to take assignment risk. All right. So there may be a selling strategy in both of these, but it's really kind of a professional. You're sitting in front of your screen until the bell. If that is something you are interested in doing, we have clients that do that. It can be done. That is not for the part-time trader. All right, so daily versus weekly versus monthly. So even though you can collect the most on dailies or weekly options when you're trading near the money, all right, and covered in calls and cash secured puts, all right, there is a trade-off. All right, if you're doing cover calls and cash secured puts on a daily basis, there's some money to be made there. But there's a trade-off, and it can be costly. So in return for that extra premium, you're being exposed to tremendous price exposure. All right? So, and what do I mean by that? Well, let's take a look at how things worked out selling options on Monday. September 12th. We had a nice little rally. Who remembers that? Let me change this to SPX. And we had options that expired on, you guessed it, the 12th. So let's take a look at a couple of things here. One, Monday's range. So I'm going to pull up a tick chart here. It's a 5-day tick chart. And let's look at Monday's range. So here we are Monday. And on the open, we opened 2120. By the close, we got as high as 2160. So if I had sold, let's say, vol's really high, right? VIX exploded. I think I want to sell some call premium against my long position on a daily option. Well, hey, vol's really high. Why not, right? All right, well, if I go to the 12th, let me get through here. You can see there's a lot of money to be made. I could have sold The 2135s for $5.50. That's not bad. There's money to be made there on the 2135s, right? Well, except wah, 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 wah. The 2135s went out $25. And let's look at the strike range for the day. No, they're not going to give it to me. But those 2135s traded for, you know, clearly they traded a lot. Does any of your strategy involve being long calls or puts or spreads or counters? Yes. We're not going to dig into those today, but almost all of our strategy involves hedged. Wouldn't you sell puts if it was going up? Maybe. Or maybe I'm selling calls. You know, maybe I'm buy writing. You know what's the if I do a buy write, that's essentially a long call. That's essentially selling an in-the-money put. Or it's basically selling a put. So, and we're really just talking theoretical here. I'm trying to make a point on buy writing. Buy writing is the most, which is buying stock and selling calls, is the most common trade. So her question is, why wouldn't you just sell calls on the way down and sell puts on the way up? Brilliant idea. But we're kind of discussing, and you would be buying futures. You'd be buying futures and selling SPX. You could also do SPY. Or you could do combos. So we're just talking in the hypothetical here. So dailies and weeklies are for seasoned traders because of that gamma. If it moves in that day, you have problems. What is the ticker for the futures of the S&P 500, ES, or SPZ? So now let's talk about the real edge in dailies. The real edge in dailies is strategic placement of the trade. You can pinpoint with all these expirations, you can pinpoint exactly when you want to trade, and you can analyze event risk. So one of the values of the dailies is determining how and when we think the market might move. So I don't know if you've heard of this Federal Reserve, but apparently they're a big deal. And they've got a meeting coming up. And right now, using the weeklies expiring on the 23rd, so that on Wednesday, the market is looking for a $48 move between now and expiration on the 23rd. That is how much we're looking for over the next week. 48 bucks. Call it 2.5%. Strategic placement. FOMC is coming. I can set up a trade around the FOMC or non-farms. So you can see if you look around, you can actually see, oh, here's FOMC. Non-farm payrolls are on the 7th. I can trade non-farms here. So I can actually trade around everything I'm doing. All right, so here's just a simple covered call strategy. All right, so the market today opened up about 4 points in the SPX, putting the S&P right at 2130. On the open, I could sell the 2140 calls for as high as $5. When the market backed off, I covered the trade for a nickel. So one thing you can do is actually trade these in, and I actually would point you toward SPX as opposed to SPY for the potential tax advantages. All right, there could be some real tax advantages. So the idea is, oh, the market is meandering. So I really like these daily strategies in a low vol market where I'm you know, they say don't pick up nickels in front of a freight train. Well, you know, you can pick up nickels when you're in Chicago and the freight train is in Rockford, Illinois. You know, we don't get a lot of clarity on the market in an overnight basis, but if you look, how much of market movement occurs on gaps relative to intraday? Most of the time. A huge amount, except for in the most wicked moves. So if we open up and not a lot is happening, and we get to 9 o'clock, and not 9 o'clock Central Time, 10 o'clock Eastern, and still not a lot is happening, and the news is out, if you want to sell puts, I might wait till the European close at 11:30. If you want to sell calls, I might do it right there. And then close them into the European close. So on the low, the 2120 puts trade over $4 today, around noon, right around European close. Sell them. By 2 p.m., I could have covered. Because of rapid decay and high gamma, call overwriting and strategic cash secured put selling can be ramped up. It can produce a lot of cash. However, there's risk in case things blow up. So while one might be able to always do this, there's always the risk of the underlying moving hard one way or the other. So the key is take quick profits. Go for $1 or $2 on SPX. Don't go for 10. Don't execute when the market has momentum. When the market has been moving at large clips, all right? All right, now, the final is you can use market momentum to leg into spreads rather than selling naked. That can be a great way to leg into call spreads for free or put spreads for free or really expensive credit spreads or butterflies. So we love it for strategic overwriting, wheel trading, flies, standard calendars and double calendars, and directional calendars. Love them. So Decay is nuanced. Weeklies and dailies are good for credit and debit spreads. They're great for strategic placement and great to finance. So here's my special offer. On the 24th, so Saturday the 24th, it should say that here. There you go. So on September 24th at 8:30 Eastern Time. I know it's early. Mastering the trading of daily options. People were asking about complex strategies. We're going to dig into those. This is going to be a 3+ hour class. We're going to talk about trading butterflies, trading calendar spreads, Directional trading. All right, buying these. Legging into spreads. We're going to teach you some things on how to leg. We're going to teach you how to trade them not on the day of expiration. How to trade them further back. Talk about how they may develop. So go to optionpit.com/dailies. It's normally $2.97. So after we're done doing it live, we're going to put it in our store, and we're going to charge $300. Today, it's just $167. Use code 25_off, OFF, all in capitals, and you take an extra $25 off. $142 for 3+ hours. You get to keep the recording. If you can't make it, we'll send you the recording. We send you the materials. We'll answer your questions. We're going to teach you all kinds of stuff that we do as professionals. You go to optionpit.com/dailies. That is also where a replay of this webinar will be placed. So you're going to get an email tomorrow saying, check out the replay. You're going to have to scroll down a little bit, but it will be on the landing page for this offer. Any questions? What trading chart platform are you using, by the way? We use LiveVolX and Thinkorswim as our two main platforms. Especially, and if you're going to use SPX, Thinkorswim is very difficult to use because of how they because of their inability to calculate a forward roll. But yeah, we use LiveVolX and Thinkorswim. What time do the dailies expire? At the end of the day, 3:15. Any suggested platforms to backtest strategies easily? I can think of a few. That's an offline question. You can email me or call me on that one. Kind of depends on what you need and what you're looking for. All right, guys. What time? That's out. No, this is SPX options expire at 3:15. So do SPY. Hey, I'm glad you enjoy it. Check out this webinar. You're gonna like it. All right. Any other questions? Otherwise, I'll let everybody go. All right, guys. The crickets say goodnight to you as well.